All right, why don't we get started today? Hi, my name is John Vance. I'm president of Vance Wealth. And today we're going to cover our 2021 mid-year and market and economic update. I've been doing the annual one for, I think about 20 years now. And the mid-year was a nice addition here that we added about 10 years ago. So hopefully you'll enjoy it. Really, the purpose of today is to provide an update on what's going on in the world, from an economic and market standpoint, just to give you an update as clients as to where things are currently, how things kind of shaped up through the end of June, through the first half of the year, and then to really kind of go over some basic education around trends that we're seeing, areas of adjustments that we're making in the portfolios. I think also more importantly, I know I have a lot of one-on-one dialogue with many of you over the years, and there's so much negativity out there, and sometimes I feel like we're the only maybe voice of reason and positivity. So, I do have, we're going to go through things that I think are positive. There are some negative issues on the horizon. One we spoke about last month, which was inflation. So, but just like any kind of normal cadence that we cover today, just from a kind of a general housekeeping item, and I have a note here. So I just want to make sure that, during my conversation today, please ask your questions in the Q&A section. What I'm likely going to do, because there's a lot of content we're going to go through, is I'll refer back to them towards the end. If there's a natural break based on some of the topics we're going through, I might take a peek. But what I would do is go on there and, basically the best way to ask questions is by using the raise the hand tool. Let me just see here. Yeah, so use the Q&A tool to actually go ahead and type your questions in. I think I got those instructions right. If not, Tara can let me know. So without further ado, we're going to get started. So again, John Vance, president of Vance Wealth, to give you our mid-year economic and market update. And of course, these are our disclosures. This is the opinion of John Vance and Vance Wealth. All right. So just real quick, I want to kind of remind you, one of the fun things for us to look back is like, what do we do as a firm? What's our mission statement? So to help our clients and families succeed at every step of their financial journey, inspiring them to achieve more, being by their side to help make the difficult decisions, celebrate life's joys, and be a trusted partner every moment in between. So a couple ways we like to look at that as well is think differently, be purposeful, achieve more. Those are really things that we try to stand by here at Vance Wealth. So hope you enjoy. So let's kind of jump in. Whenever I do the annual or mid-year updates, sometimes it's like drinking through a fire hose where I have a lot to cover and really getting into the weeds on some of the things. I really tried to summarize it today because I think given the amount of webinars we have been doing over the last 18 months, especially as COVID started, there's a lot of data that I've been sharing, and I know many of you continue to tune in. So I wanted to try to make it as simple as possible, but we do have some slides that we need to run through. The first one has got a lot of data, but it's actually really easy to understand. So one of the things that I warn you is as I pull stuff up, remember a lot of it is real simple, and I'll do my best to kind of walk through it. But just because there's colors and lots of data doesn't mean it's complicated to understand. So let me just give kind of an update on where things are. So if we look at just kind of high level, this is a chart that basically goes and looks at stocks around the world. So it looks at the stock markets around the world, and the data we have here goes back over 10 years. So 2011, and then the data on the far left, on the far right is year to date. So that's year to date for this year. And so one of the things is as you look at the different categories, let's just start with this year because this is kind of most relevant. You can see the one category that's been doing the best are small cap stocks or small company stocks. And then the next category is value stocks. The next category is mid cap, which is medium size. Then you have the S&P 500, which all of us are familiar with. And then you get into growth stocks, right? Those are like more technology, healthcare based. And then you start looking at kind of the bottom of the list for this year, global stocks, which means US and international. And then we get into international small, international, and then emerging markets. Emerging markets would be like China, India, Russia. So what's pretty fascinating is you can look at the leadership of this year was different than the last few years. If you look at 2018, 19, and 20, you can see the green represented by growth. Growth has really been in a place of outperformance over the last, not only 3 years, but honestly over the last 10 years. But one of the things that we do know about building a portfolio is that leadership changes. It's rare that one winner progresses year after year after year, and leadership tends to shift. And if you've been reading anything that's been coming out either in our newsletter, just some one-off emails from our team, we've been in the process, we've done this a few times now over the last 9 months, is in rebalancing accounts. Because we've seen such extreme volatility, it's really caused us to rebalance, meaning when we look at what I have in front of you is we tend to balance the portfolios using all of these different types of investments. And we know over time that's going to benefit our clients, but we honestly don't have a crystal ball, so we don't know when they're going to outperform or underperform. And a big part of our portfolio management is to keep them aligned with our targets, keep them aligned with your financial goals. So again, this is just a little bit of an overview of what's happening this year. And those numbers that are in all those boxes, that's the percentage return for the year. And on the far right, it's just through 6 months. So one of the things that's pretty remarkable, where we are today in terms of our economic recovery, the fact that, last year and this year, we've seen really positive results. And if you recall, as COVID was starting, we saw tons of volatility to the downside. And while that was concerning, we had, I hope we would call it foresight, but we were really confident that this was going to resolve itself because of the massive stimulus that was happening at the federal government level, from the Federal Reserve, happening, frankly, all over the world. And now we're bearing the fruits, I guess, of the stimulus and the recovery, but there's still a lot of headwinds, and we'll definitely chat about that today. So this is just, again, looking at the stock markets of the world. Then I go on to hold on here, let's make sure I get on there. Then we go on into a look at what we call asset allocation. So what if we just said, what about these major asset allocation class returns? So if you look at the far right, what's driving the markets, I guess, over the last 6 months? Commodities is the #1 performer, and commodities would be things like gold and copper and oil and lumber. And one of the big reasons we're seeing that, as you can see, commodities were the worst performer this last year as COVID really slowed the economy down in the first half of the year. But they've been the strongest place because there's really a shortage, right? We're having supply issues, and there's a tremendous amount of demand. The housing market's creating a tremendous amount of that demand. And so commodities have really led the rally. And then as you look down that list, look at the very bottom. That abbreviation there is US Ag. That's the US Aggregate Bond Index. And so bonds are slightly negative for the year. And so, one of the things we know from a diversification perspective, I think most people view cash as the very safe, bonds as kind of intermediate and stay on the safer side, with stocks being the most aggressive. And while that's true from a volatility perspective, one of the things that we do know is bonds can lose value, especially when you compare them to inflation, things like that. So this is a good reminder of why diversification makes sense, because if you're 100% in bonds, you're trying to be more conservative, you're in a negative return. And if you're in cash, we know how low rates are. And so it's a really good reminder of why balance really makes sense in portfolios. And so again, this was just designed to be a little bit of an exercise to see kind of leadership through prior years. And again, there's no common theme. There's no one category that always wins. We tend to have a little bit of this ebb and flow, and that's a big part of investing, is we understand that's going to happen. And while it would be amazing to have a crystal ball and predict what's going to happen, or at least have the playbook ahead of time, it's just not a reality. And so what we have to do is recognize that we know the returns are going to be they're going to be unpredictable, and the only thing we can do is rebalance and make adjustments as things occur. So again, just high level. So I guess the snapshot is last year was a really strong year for the equity markets and the real estate market for that matter. This year, the first 6 months, been really strong again. And that was pretty much our, when we started the year, that we thought this year was going to be another strong year. And, I want to spend a little bit of time of what's driving that. What are some of the headwinds, concerns we have? And then again, getting back to some of the themes on why we think this is still going to be a really strong decade. Okay. So, me, I guess I would maybe be a cautious optimist, where I am optimistic, but not without caution, because we want to make sure that we're being careful. But there are challenges. There's no doubt about that. I think the hard part is, if any of you are watching or listening to the daily news, not whether it's CNN or CNBC, whatever, Fox News, whatever your news source is, or listening to talk radio, unfortunately, I'll turn it on from time to time, but I can't watch it for very long because it's so negative. So all of it is 100% challenges, and there are things that are out there. So we can't sweep them under the rug and pretend like it's not a reality. but it's not everything. It doesn't drive everything, but unfortunately that's what we deal with. And that's why I tend to prefer to get a lot of my news through sources that I read, because then I only have my internal dialogue going when I read it, and not necessarily the inflection of a reporter. And it tends to allow me to dissect that information a little bit cleaner and hopefully with a little bit less bias. Again, that's just my personal expectation. Plus, when I get home from work, I want to shut down. I don't really want to watch the news. We do plenty of research and studying throughout our days here at Vance Wealth. So, all right, current challenges and those that are on the horizon, things that we think are on their way. So this is really kind of two issues we're dealing with, but the same one. So the chart that we have here is the Federal Reserve balance sheet. So, we've talked about that term printing money. So the Federal Reserve essentially has the ability to print money. They basically make money from out of thin air, and they put it on this basically manufactured balance sheet, which means that they're printing money, taking money out of thin air and putting it out there into the economy. And you can see, as you start looking in the middle part of this, in this table, it says treasuries, mortgage-backed securities, which is MBS, and then loans. So the Federal Reserve will go out there and buy treasuries, go out and buy mortgage-backed securities, go out and provide lending. And so you can see, what's pretty remarkable is if you look back, this chart goes back to 2003. And in 2003, balance sheet was relatively small. It was under $1 trillion. And it pretty much remained that way until the financial crisis hit in 2008. And then you can see the impact of what we had to do to stabilize our economy. It really jumped the balance sheet. And we could probably all argue by about 2011, the economy was on a mend. But you know what? The Federal Reserve took this posture that, hey, we got to keep supporting the economy. We got to keep supporting through expanding our balance sheet. Now, longer term, that's dangerous if you think that at some point we have to unwind, meaning we have to basically stop printing this money. This chart suggests that it's going to continue to go on, which is why we're hearing a lot about inflation, right? That's kind of the next item that people are really concerned about. And the reason why inflation is becoming more of an issue, and there's multiple factors, and again, I spent a whole webinar last month on it, but this is a big driver of it, is the fact that we're basically printing money. You can see where we are today in 2021. So we've essentially gone at the start of the financial crisis, about 13 years ago, we had about $1 trillion on the balance sheet. And now looks like we're pushing close to 8 trillion, which is insane, right? So when we start looking at all of the money that's going out there, and then plus we have a bonus on the right side plus we also have a $28.5 trillion in U.S. national debt and growing. So those are the big factors. Those are big negatives, right? Because that's money that we owe in the future, and it's not a good thing. This is not panic. It's not a panic sign yet, but these are trends that we need to start to slow down. When I say need to, I guess that's in my opinion. We should start to slow those down because it's not likely sustainable. This is noisy, but super easy to understand. This is a chart that goes back to 1970, basically, 1971. So we're looking at the last 50 years of inflation data. And inflation data is primarily measured by CPI, or Consumer Price Index. And so you can look at in this box, it says the 50-year average for the headline Consumer Price Index is 3.9%. But look at what we've been living through. And you can kind of see here since 1991, we have been below this long-term average. This long-term average is this dotted line. So we've essentially been living the last 30 years below normal, with more recently in the last 10 years, well below normal, right? Well below like 2.5%. So I think inflation for most people has not been a big factor, but then what happened as we've been coming out of the COVID, meaning the reopening kind of post-vaccines, you can see in April and May, we started to see inflation spike. So the one thing we don't know is this temporary or is it permanent? My thoughts are it's a little bit more on the temporary side for the next couple of years, and then we'll find a way to fix that. But this is definitely a concern. I frankly think that, and I'm not going to spend too much time on this because we did this last month, but I do think the government and the Fed they're trying to create some more inflation. Because when you owe a lot of debt and you cause inflation, what happens? Your debt essentially is the same because you borrowed it. And then if you have inflation, what does that mean? You generally bring in more tax revenue. So if you bring in more tax revenue, you can service that debt a little bit better. So that's where we're starting to see, I think, some of the desire for some additional inflation, but it does erode purchasing power. So that's one of the big concerns that I think individuals are starting to have, and that's definitely something we're seeing pretty much every day written about in the Wall Street Journal and other major business publications. So, and this is what I was referring to is really the rise and the fall of the dollar. So this basically shows the purchasing power of the US dollar going back to, essentially when, the Federal Reserve was created, and we're using 100 as the baseline. And then you can see kind of the erosion. And this is just basically a flip of what inflation would be, right? So if inflation means a dollar is worth, what a dollar in 1913 would be, would be worth something like $100 today, right? So this just shows the purchasing power, the erosion of the purchasing power, which is one of the reasons why we're not big fans of holding too much cash or too much bonds. We want to hold the necessary amount based on your risk tolerance and your cash and spending needs, but we don't want to hold too much of those, because those are terrible investments when you factor in inflation. So this does show the erosion of that, and that's going to continue to occur. We do want some inflation. We just want modest inflation, and the Fed's kind of mandated modest inflation in the 2.5% to 3% range. So it does look like for at least the next probably several years, we're going to be above that. But the Fed did state that was their objective. So we expect more inflation. And, I keep getting the question over and over, is inflation a good thing or a bad thing? Well, hyperinflation is not great. Sustainable above 5%, not a good thing, because it erodes purchasing power quickly. 2 to 3 to 3.5 for a sustained period of time, it's maybe not terrible. Remember, businesses have the ability to raise prices to sell their goods at higher prices. Home prices are appreciating. Is that good for homes, for home builders? Of course. Is it good for homeowners? Yeah, if you own a home, right? Because the value has gone up. So not all inflation is bad. Okay, so international diversification. So a year ago, we always maintain diversification across the world in the portfolios that we manage. We have a heavy US bias. It's always been that way. As we were starting to kind of figure out what was happening with the economic recovery back in April, May last year, kind of in the depths of COVID as it was hitting the stock market, we made some decisions to add a little bit more to US because we thought the US response was going to be swifter. That has occurred. So over the last few months, we've actually been rebalancing portfolios and adding back a little bit more international diversification. So I want to kind of remind you of why it makes sense, especially now. It always makes sense for some, but why we're kind of coming back to our more neutral weight, because we've been favoring the US here as of late. So the two charts we're looking at right now is looking at the world from two different perspectives. On the left-hand side is representing by GDP. So what is the GDP percentage of the world? What is each country's relative weighting? And so GDP is gross domestic product. So it's measuring economic output based on these areas. And so if you look, China has the highest. 18% of the world's GDP is from China. 16% is the United States. 7% is India. 4% is Japan, and 3% is Germany. So right, those four or those five countries obviously are either massive populations or very strong economic countries. So and then you look at the rest of the world. On the right-hand side, it actually shows market capitalization of the world. So in terms of where the companies are domiciled, where they are headquartered, so to speak, and what percentage are they in different countries. So if you look here, 44% of the world's market cap, meaning the valuations. We know the largest company currently is Apple, with Microsoft, Google not too far behind. Microsoft, Google, and Amazon not too far behind. But 44% of the world's companies are basically based out of the US in terms of market cap, meaning size of the companies. 9% China, you can see the list there, and 30% for the rest of the world. And so what this then suggests is that, when you look at the rest of the world, that potentially there's more value in the rest of the world. Well, one of the things that we do know, and this happened back in the 80s, it really started, is the revolution of the global American brand, right? When you started looking at these amazing brands like Coca-Cola and Nike that really started being pervasive throughout the world, is that, yeah, they might be based here in the US, but they do sales, they do sales all over the place. And I think the S&P 500, I think roughly over somewhere right around 50% of their sales of all those companies are from overseas. And so we can't pay too much attention around where they're domiciled or where they're based or where they're headquartered, but it does give you an interesting perspective of, why our wealth in America has been so strong, is because, the best companies are based here. So this is a really easy chart to explain. So let me walk through. When you look at international markets, essentially they're measured by something called the MSCI EFE. And so I believe it's like the Morgan Stanley Citibank Index, I believe, and it's measuring Europe, Asia, Australasia, and the Far East. So, and then you have MSCI USA, which is not quite the S&P 500, but it's a reasonable comparison. So if you look at this chart, this goes back to 1971, and it basically shows periods of US outperformance, which is in the gray, and then international or EFE outperformance, which is represented in the purple. And this also shows the magnitude of the outperformance. And so you can see it's been obvious what we've been living through the last 13.6 years on the far right is that US markets have outperformed by 237%. So that's the largest outperformance that we've seen. And it's not by accident, right? We have great companies. We've had a pretty unified Federal Reserve policy. We've had tax policy that's been more favorable. So and we were recovering from the Great Recession, right? So these were a lot of factors that really added up to us doing well. And if you look back over several years, you can see, we had, the late 90s was another period where we outperformed. The late 80s was another period, but then you look, international has periods as well. Now, the largest one on there is kind of shocking, right? It's kind of the mid 80s where international outperformed by 374% over 6 years. So, we don't know when this is exactly going to change. What I will tell you is, we've been talking about this for the last 5 years. And, at some point, this leadership is going to start to shift. I think we're getting closer to that. A big reason for that is this: valuations. So international markets tend to trade at cheaper levels than the US. And so if you look here, this 0 represents, meaning if they would trade as a valuation, meaning what are they worth using price to earnings ratios, with that, using this baseline of 0. So 0% would mean that they were basically valued the same. An international company or a US company, their price to earnings ratio would be the same. And so you can see this goes back over the last 20 years. We haven't had very many times just at parity. So the average is that international trades at a bit of a discount, about a 12% discount. Look where we are today. We're at about a 27% discount. So we're getting down to this realm where international are trading at such a severe discount. And we all know, what's really the secret to being a good investor is you buy things low and you sell them when they're high. And not forecasting when this is going to change over, but it's a healthy reminder that, this discount that is occurring here, it will likely remedy itself, because when things are cheap in nature, they generally find investors, and that'll kind of move it back to a little bit more of a parity, moving it back towards average. So again, that's just some of the data that really suggests that we'll likely be headed on that path, at least over the next decade. I can't tell you what's going to happen over the next, let's say 10 months. Okay, well, this is really, I guess, a big chart for the case of optimism when you start looking at what's happening with the world population. So I want to hit this point pretty quickly, but you think about what the phone is doing. You think about what 5G is doing. It's really connecting the whole world. And so when you look at the fact that most of our population is living in, maybe we're not go as far as poverty, but for sure not middle class. I think we probably could argue that it is, most of the world lives in poverty, but let's just make the argument that most of the world is not living in a middle class environment. But look at the data that we're looking at now. So this chart on the left shows the projected growth of the middle class. So in 1995, we're just going to start on the far left. India, 1% was in the middle class. As of 2020, it was 21% and forecasted for 2030. So 10 years out, jumps that number up to 79%. Now, I don't know how they're measuring it. You can look at the disclosures down there and where this is coming from. But it's I really believe the Brookings Institute and other resources. But this data is pretty staggering. Look at China, 1995, 0%. Now 41%, projected in 2030, 72%. Mexico, 40%, 73 now, projected to be 79. So you're seeing the growth of the middle class. And this is we're seeing massive amounts of growth in middle class, which are going to start demanding, frankly, a lot of these great global brands, a lot of them being US companies. And 5G, the phone, is really connecting the world, where it doesn't matter where you live. If you can get access to 5G, get access to the internet, you can really get connected with the world no matter where you live. And then you can just kind of see like where all the contributions are coming from. You can see obviously China and India are really driving these numbers in terms of where the contribution of middle class growth is going to come from. So hopefully this just gives you a little bit of idea of why there's reasons to be optimism. Is, I think a lot of times we look inward and just say the US is struggling, and clearly there are patches of our country that are struggling, and it's not things that we need to neglect. But when you look at it on a global scale, there's a lot of promising things on the horizon. All right. Okay. So how I like these megatrends, and I keep pulling it from different places. A lot of portfolio managers, write about it. They all have a little bit of a different take. So I pulled one from another that I like, is the Lord Abbett Growth Leaders. Just a really thoughtful manager. That's not necessarily a recommendation, just making note of where the data has come from. So let's talk about the megatrends that will define the next decade. So there's someone by the name of Ray Kurzweil, and he's really kind of, for lack of a better term, is kind of a futurist. So is spending a lot of time on the future of the world, where things are going. And there's this concept that goes way back called Moore's Law. And this is idea that technology is really growing exponentially, and that things are growing far past what we can even fathom as a human being. And so what we're looking at on this chart, and again, this is a projection, but it goes back to 1900, and this is plotted by the number of calculations per second per $1,000. So it's designed to measure, basically what the power of money, what it can buy, and the speed. And so what's pretty fascinating here is basically that, as you look on this chart, and we'll make these presentations available, but basically as you look at this chart, it kind of shows one insect brain, one mouse brain, one human brain, you can see right here, which is the equivalent of, let's say, 5G. And that by 2050, basically that you'll be able to buy a device with a computational capacity of all of mankind for the price of a nice refrigerator today. That basically, because of where we're headed and the pace of the growth, that the speed will surpass all human brains in 2050, right? Things we can't even fathom, but it's also another reason to be optimistic. So when we start breaking it down into where are these massive changes going to occur, and just as a reminder, I've done a lot of talks on these, and there's consistencies, but everyone has a little bit of a different take. But these are the big areas that we're seeing: is technological revolution, genomics revolution, and the empowerment of consumer in brands, right? So you start looking at where's the growth right now: cloud technology, artificial intelligence, biotech, devices and diagnostic. You can see all kind of the examples: gene therapy, cancer diagnostics, being able to do targeted oncology therapies, things that are designed much more individualized versus mass scaled. And then, you look at all the e-commerce, life brands, all of the things that are happening, the streaming content, the delivery, the social networking, remote learning and tutoring. We're not far off, for a lot of our mental health is probably going to be done through some sort of artificial intelligence that, really will make it accessible to the average person to be able to have what might feel like a human dialogue using a computer. Seems kind of far-fetched. We're not that far from that. And these are not recommendations at all, but this is kind of a list of a lot of the technology innovators that we're seeing. Likely besides Microsoft, most of these names did not even exist 25 years ago. So when you start thinking about the power of the future and where we're headed, so much of the innovation we're in the infancies of it. And it's just a healthy reminder of the names that are on here. A lot of these are probably not familiar to you, or they're names you're more familiar with over the last 5 to 10 years because of the innovation that's been occurring. Then we start getting into consumer discretionary innovators. Like the bottom left, we clearly know Nike, but there's a lot of names here that are all brand new, like Yeti and Roku, right? Even Facebook and Amazon, not that terribly old. So these are things, when you start looking at the innovations, it's going to continue to push. This is that's the beauty of our economic system, as we continue to innovate, and that's the exciting stuff. And again, I'm not recommending these names: Shopify, Match. These are all newer companies that are continuing to grow. These are companies that are worth, in some cases, hundreds of billions of dollars. These are not small companies anymore, but they're relatively new companies because of the massive innovation and disruption that they've been doing. So this gets a little bit outside my scope of being comfortable in terms of the healthcare piece, but bottom left corner shows the cost per genome to basically sequence a genome. And then back in 2001, it was, what was that, $95 million to do that. And now the cost per genome is down below 1,000. You look at the bottom right-hand side, less than 0.1% of the US world's population has been fully sequenced. It's only 1,000 genomes sequenced, 1 million genomes sequenced, and look at the world population. So this is going to be something that's going to really drive innovation because it'll be more individualized to people to take care of their specific health issue, disease, and this is going to continue to push the boundaries, continue to push hopefully our longevity, and not only longevity meaning living longer, but also hopefully longevity, living longer and living healthier. And so again, these are a bunch of names, probably not many familiar names here, right? And these are the growth companies of tomorrow. Again, not recommending these. I just wanted to show, when you start looking at the innovators, this innovative list is not by the old trusted and true companies. It's companies that have been developing over the last 5, 10, 15 years. And that's the beauty of, of the capital markets, is that, it really rewards those that innovate by, making them, building really true wealth, which is awesome. So when you then start looking at the great digital acceleration, so COVID has pushed us over the edge from, I think, the willingness to change, right? I think that there's been factors where, maybe you're a little hesitant on like, do I really want to do a Zoom meeting? Do I really want to do this using a technology? I'm used to signing stuff. I'm used to in person. I don't think that's going to go away with the latter that I just discussed, but we're changing, and it's changing quickly. So if we look at this, the footnote has kind of the source. I'll give you one example. So it says e-commerce is the first line. So what it shows on there is the light blue represents 2019, meaning the penetration of digital trends. And so the e-commerce is measured as a percentage of total US retail sales. So what percentage of total US retail sales is e-commerce? And you can see in 2019, Amazon had already started to kind of push there, and other industries, even places like Nordstrom, right? You can, buy and have it shipped to your house. And you can see the add-on because of COVID in 2020 was about 14, up to about 14% total. Look at telehealth visits, essentially not even noticeable in 2019. And in 2020 jumped to 20%. Streaming, so this is percentage of basically viewership, TV viewership. What percentage is streaming? You can see it already had penetration through Netflix and others, but you can see we added more in 2020. Digital payments, share of wallet. How much is getting paid through a digital payment system versus traditional sources? Cloud computing. So you can see we're still really early on in this phase, and the amount of transformation. You think about the amount of wealth that will accumulate for investors, for starters, for entrepreneurs who are developing these companies, is still tremendous. We're still early on, which I think is exciting. Maybe you get out of your comfort zone because it's different than what you know, but the reality is this is exciting. These are new things on the horizon. So another trend that we see, being in Los Angeles, especially because we really have the weather that makes, EV vehicles a tremendous, purchase, because we don't have the really cold, harsh weather. But if you look here, this disruption that's coming, look at the two major car manufacturers, General Motors and Volkswagen. Look at the number of millions of cars that they sell, with GM north of 6 million, Volkswagen north of 9 million. And then you look at Tesla, this tiny little fraction. Tesla, they're 100% electric vehicle. They're also, a massively valued company. And look at, all the change that we're going to see here when we start seeing the shift over from gas powered to electric. So this electric vehicle race you can see on there is just getting started. We're early on. We still don't even have the full infrastructure. Think about the changes that are going to have to happen with regard to taxes, as an example. So when we started talking about taxes, gas taxes. So if everyone switches to electric vehicles, how are they going to pay for the roads? Because everything's based on gas tax. So that's going to need to be adjusted. And there's going to be, we're not even there yet because there's such little, there are so few EV vehicles on the road. But I know a lot of cities are trying to pledge to be carbon neutral by a certain date, or 100% electric by a certain date. So the way we kind of look at our current infrastructure is going to have to shift. And so again, this is disruption. These are money-making opportunities. Again, this is why it's so exciting to be an investor, is because we get to put our capital, and yes, we do it broadly through using funds and ETFs, but we get to put our capital in areas that are going to continue to grow and innovate, which is really exciting. All right, so we're going to transition now into another topic, and we have a little bit more here, and then we'll wrap up. So this whole idea of growth versus value, right? Growth is all the exciting stuff we all know, right? It's the technology, it's the innovators, it's the healthcare innovators, it's all these things, the consumer innovators, it's all these companies that are innovating. They're the growth. That's kind of the growth engine. And then you have the value stuff. The value stuff is kind of the boring stuff. You know, it's the energy companies, it's the banks, it's the old line, let's say, aerospace industries. It's just a lot of this boring stuff, material companies, mining companies. So that's really the value type industries. And, you know, growth has been super popular the last 10 years. It's outperformed value substantially. But over the last 80 years, value tends to do better. So we don't want to forget about that. So our attitude with this as investors is, you know what, growth and value, balance them. It's important to have both because you know, you're going to get an ebb and flow of when things are going to do well. So I want to go through a couple charts because I thought it was fascinating just to kind of see some of the data. So this is a chart goes back to 1994. I wish I had a different color here. I got a light blue and a dark blue. The light blue represents growth and it shows the relative outperformance. And so in 1994, if we use a baseline of 100, where it could be 100 or 100,000, it doesn't really matter. And you can see where it says .com bubble, basically $100 invested in 1994 by 2000 was worth $400. So it went up 4 times over about 6 years. And you can see value, which is in the dark blue, did fine. It doubled. It went up to roughly a little bit over 200, but it underperformed substantially against growth. Then we had the bubble burst. Then what happened? Growth came way down. And then all of a sudden value said, maybe value's not so bad. And then as you look, as we kind of approached the Great Recession, which happened in 2008, value was now leading growth. And then we saw the Great Recession sell off. And then you can see they kind of bottomed around the same levels right around here. If you can see my arrow. And then you can see the recovery has been pretty much, the recovery out of the gate was pretty equal, but starting in about 2014 and 15, it started to really diverge and growth has clearly been the leader. So I think what that is causing is maybe some bad behavior. People only want growth because we have a very short-term memory and we say, hey, the last 5 years, the last 6 years, the last 7 years, those have to be the trends that are going to be followed. But our attitude is no, you want to balance both and be careful because if you don't, that's where individual investors get in trouble. Because I remember the same type of mentality back here during the .com bubble. Kind of fascinating when we started looking just in the last, this is a really short window here. So this is not my term, but you can see here November 9th or vaccine day, right? This is when the vaccine was starting to get rolled out. So basically pre-vaccine announcements. So we're going to look at returns. So energy service companies, basically from January 1st to vaccine day, lost 56% of their value. And then post-vaccine day, this data is through the end of May, up 90%. Oil and gas, down 49, their recovery up 84, airlines down 45, up 63, you know, hotels and cruises down 42, up 53, right? So you can see kind of like these are more traditional value type investments. And they really got hammered during the start of COVID because they're more cyclical. This shutdown with the economy really impacted them at most to the highest degree. But you can see the recovery they've actually benefited the most from the recovery. So again, our big theme on this is value, or it's not value or growth, it's value and growth. And it's important to balance both. And, you know, I showed you some of the charts right at the beginning is, you know, growth was the best performer last year. Value is outperforming it this year. So a healthy part of rebalancing allows you to ebb and flow and be able to manage your portfolio more effectively. And that's what we're doing for you. This is just a reminder of kind of what we've been through over the last 25 years. By all measures, markets are getting a little stretched, a little bit overvalued relative to historical norms. The problem is we're in an unprecedented time with a few things happening. Record low interest rates almost at zero, massive amounts of public spending, massive amounts of the Federal Reserve printing money. So even though by any of our measures, things look really expensive, it may not matter because there's so much stimulus that's coming that's going to dwarf the fact that the markets look a little bit overvalued. And the question is overvalued compared to what? Stocks versus real estate, stocks versus cash, stocks versus whatever. The markets are overvalued relative to historical numbers. But the question really is does it matter? And I think the short answer is not right now. At some point, yes, but not right now, it doesn't. The big reminder out of this chart, it shows The dark blue line that shows basically the S&P price and earnings history over the last 20 years. And it shows the dark blue is the volatility of the markets. The light blue represents earnings per share. And when put on a chart together, you can see they're highly correlated. So at the end of the day, we know, why do stocks go up? It's because profits of the companies inside these indexes are going higher, right? The largest four companies on the S&P 500 are Apple, Microsoft, Amazon, and Google. Those are the largest four. And they are some of the most profitable companies out there. And so there's not a mistake of why these things are moving higher. And we don't think that trend's gonna turn. Now, the other part of it that I mentioned is stimulus. I don't know what we're going to settle on. I think this was the original stimulus, what was this called here? The proposed American Jobs Plan. I think we're going to get a scaled down version of this, but this is basically what it was looking like infrastructure at home, a transportation support, business support, caretaking. There's a lot of things factored into this. This was the over $2 trillion. Looks like it's coming back, but again, it seems like the playbook's going to be for not only the Fed or the federal government is, if we have a problem, throw money at it. Now, that's dangerous long term. I don't know if we want to give our politicians or our Fed that much control to just have a blank check. Essentially, they have that now, which does concern me. But the whole adage is, don't fight the Fed, don't fight the trend. If this is the trend that's occurring, we got to ride that wave and continue to rebalance and take profit off the table as markets go higher. And that's part of investing, is being disciplined with that. And good news is that's what we're doing for you. All right, okay. Volatility. Don't want to spend a lot of time here, but volatility is normal. This was a chart going back to 1980. If any of you have been in a webinar before with me, you've probably seen this ad nauseum. This basically shows that going back over the last 41 years, and this shows it in the top, the intra-year declines, meaning during the year, we have intra-year declines that average 14%. That means at some point we get a 14% correction. That's just the average. This year, we've only seen a 4%, which is in the very far right. Last year, the sell-off was 34%, which we all remember, which was last February, March, and April. But the markets were positive 31 out of 41 years in spite of this intra-year volatility. So volatility is not going away. It might be on the horizon. I know yesterday was a little bit of maybe a frightening day for those that watch it every day. It wasn't really for us because we know that's normal. But volatility is not going away. It's probably going to pick up. We're going to use that as an opportunity to buy, to be good investors. We don't think this should cause people to shift. And the question I'm getting now is, well, what about the Delta variant? And what about some of these other COVID issues? And they're still real. They're not going away. But we've already seen the playbook. We know money's going to get thrown at it. So even though there might be disruption in reopening, we're seeing disruption here in California with the mask mandate, especially in LA County. So we are going to see disruption. That's not going away. But we're going to be using volatility to be investors, to be buyers, and using volatility to the upside to take profit. And so that's the discipline we're going to continue to impose. And but be prepared. We might have a 10% correction. We might have a 20% correction. Those things are normal and part of investing. The hardest part, and I'm kind of speaking, I haven't looked to see who's on the call today, but the hardest part is for my retired clients, right? Because if you've amassed a $3 or $4 or $5 million portfolio, 20% is a lot of money. On a $3 million portfolio, that's $600,000. On a $5 million portfolio, that's $1 million. So I'm not trying to pretend that that's not real, but that's why we diversify. We expect, as part of it being a good investor, that's going to happen. We don't know when, but we have to be ready for it. And so I guess the kind of the warning or the word of caution here is that it's coming. It's not going away. And so be prepared mentally. We're here to help. We're here to answer questions. We don't market time. So, part of it is we are going to ride through the ebbs and flows because we can't predict the future, and you don't want us guessing. That's not our job, is to sit around guessing what's going to happen in the future, because nobody knows. And then this is just a healthy reminder of focus on long-term results. So this goes back to 1950. So I would argue a pretty long period of time, 70 years. And the green represents a stock portfolio. It's like a lime green is a stock portfolio, and the blue is a bond portfolio. Now, what this basically shows is the range of outcomes over the last 70 years. So I'm going to focus on the 1 year, and I'm going to focus on the 20 year. So the 1 year is on the far left. So this shows that in the stock market, the best 1 year return has been positive 47%. The worst 1 year return has been negative 39%. And if we look at the gray, which is a blend of the two, meaning if you were half and half, the best return over a 1 year is 33%, and the worst return is -15, right? So that kind of bodes well for diversification. We look at the flip side, all the way to the right, and look at 20-year rolling periods. So this looks at 20-year periods. The beauty of being a long-term investor is, at least over the last 70 years, we have not had a 20-year rolling period with negative returns. In fact, the range, which is shown here, shows you that the best compounded 20-year return was 17% per year for 20 years, which is massive wealth accumulation. The worst was 6% per year for 20 years. And then you can look kind of the blended portfolio as well. So this is just a healthy reminder, is as you go longer term, as you focus on long-term results, that starts to actually lessen volatility. The short-term volatility is here to stay, and I wish I could get rid of it. You can't. You got to embrace it. All right. Well, it looks like I do have some questions. So just real quick, if we have any guests on the call and they want to have a portfolio review or have a complimentary consultation, we're trying to do a lot of stuff via Zoom, especially just kind of given some of the more recent issues with COVID. And, I don't know if this has been personally true for many of you, but we know several people now that are vaccinated that have tested positive for COVID. So not in our office, but just people that we know. So that's something that we're becoming a little bit more aware of, and we want to make sure we're protecting our team and also our clients. So but if anyone's interested, our next webinar is going to be on August 17th at 4:30. Still haven't determined topic. I think it's going to be probably the keys to be a successful investor. So we'll go through some of the key topics for next month. So we are now on to questions. Hopefully this has been valuable. Let me stop share. I think it's just going to show me once I stop share. Tara, if it's not showing me, let me know, but let me jump in here to some Q&A. Okay, so asset allocation is an asset class. Slide 2. Okay, so the kind of a question mark. So so that was one of the questions. Thank you for that. Essentially, asset allocation is an asset class. So if you looked at all those boxes, it kind of looked like the periodic table in chemistry, right? So the whole idea is that, having a blend, meaning you have US, you have international, you have large, you have medium, you have small, you have growth and value. By putting them all together, if you plotted that point, it would basically never be at the top, never be at the bottom. And so if you view a portfolio basically as kind of its own asset class, and so that's what that is referring to, without me going back and looking at it. But I do think that's a good question, so thank you. Let's see here. This is more of a comment. Okay, so good question. I don't know if I have an answer, so I'll share the question, but how will the more aggressive mutations of COVID affect your projections? So that is kind of the $1 million question, right? So the hard part for us to really kind of wrap our head around is, well, what's this going to look like, right? I think many of us are getting used to some normalcy, getting back to vacations, getting back to, again, traveling and seeing more family. And so I don't know if it does have an impact on my projections. And here's why. The challenges we're going to have with COVID, I think we were probably, at least for me, naive that this thing was going to resolve itself a lot faster. It hasn't. It's clear that this is going to continue on in some form for the next couple of years, likely. In what form, I don't know, but it's going to last longer than even maybe I was willing to admit, and maybe that was the challenge, even like just admitting that. So, but I don't think it's having a permanent damage on our economic system. I think a lot of these things are temporary, and frankly, the government in some cases are responding correctly to it. There are some things I think we can't encourage people to not work. I mean, there's some different things that I want to, most of the business owners we work with are struggling to find good people. And so that's a challenge with education, and it's a challenge with having incentives to not work. And so that has to be resolved. There's nothing that's happening that's, in my estimation, that's going to change the permanent landscape. If anything, if we have more COVID issues, what does that mean? More stimulus. What does that mean? Tax policy, all these tax changes that I know a lot of investors are worried about, they're probably going to be put on hold because the last thing any politician wants to do, in spite of maybe how whether you're on the left or the right, is they do not want this economy to go into a full-blown recession, right? We were in basically the shortest recession we've ever seen because of a lot of the stimulus that came in, and it's a politician's worst nightmare if we actually go into a recession because it'll be on their watch. And so if we do have more lockdowns, more outbreaks, things like that, unfortunately, we're going to lose more lives, which is devastating, but we're also going to be in a position where the government's going to likely continue to stimulate and continue to move us forward. The disruption that we're talking about with technological disruption, the genome disruption, the electric vehicle, all those things are still on track, though that's not going to be disrupted. And so I don't think it changes it. For sure, it's hard to even fathom the size of our economy, right? When you start talking that the US economy is in the trillions of dollars, of course, there's going to be some impact on individuals, on companies, on policy, policy decisions. It might take some wealth off the table. I don't know, but it's not going to change really the outlook, because I do think the path that we're on is the path that is we have like enough momentum, and that's not changing. If anything, COVID's disrupting that in a positive way, where it's forcing people's hand, it's forcing change. Especially with, kind of what I would say the older generation, which is, the post millennials, right? So, like 40 and up, because we kind of have ways of doing things, and, the younger generation's used to changing. So that's kind of it for questions today. So hopefully you found this valuable. I know a lot of content. If you have any questions offline, if there's anything you're concerned about and you want us to address them individually, didn't want to share as a Q&A, we're here to help. And hopefully you're having an amazing summer with your families. Stay healthy, stay safe, and we'll be in touch next month. Thanks a lot.